Welcome, everybody, to Catapult Your Business, where we help catapult business owners one question at a time. I've got a client of ours from Cultivate joining us today, and he's brought an awesome question. He's in a super asset heavy business. And we've already started to have a fun conversation around what is the debt to income ratio need to be to really maximize and optimize the scalability as far as it goes into the risk tolerance, as far as it goes, how do you structure it on the balance sheet? So many good things to dig into. And I know so many people listening and watching from afar are curious, what should the right debt to income ratio be for my business? Well, you're going to see us break it down live time today on Catapult Your Business. So first, I want to introduce our guest here today, Jared Kohlmann. Welcome to the show.
Oh, thanks for having me. I appreciate it.
Yeah, absolutely. Glad to have you as well. And Jared is the founder of Pro Photo Rental based out of Colorado. And Jared, you've got a really fun story of how this business kind of came to be, right? The classic, not the garage necessarily, but the home office. And then it kind of just kept going and going and going. What got you into entrepreneurship in the first place?
That's a great question. I started out by education, I'm an engineer and started out working for someone else, but I always sort of felt that itch to do something for myself. That opportunity arose when my daughter was born and we decided to relocate. I stayed at home with her to help raise her. And at the same time felt like, okay, well, I need to contribute something to the family. How can I do that? And made a list of options for possible business ideas. My wife and I went over it, and this is what came out of it.
Well, and it's the business is great, right? It's this idea that people need to rent this really expensive equipment from small business, wedding photographers, wedding videographers, all the way up to Fortune 500 companies. I mean, there's so many different reasons why somebody would need to rent this type of equipment. And there's not a ton of options for this out there unless you know the right person or you find the right site. And it seems like you've been able to merge. I mean, you've built a $500,000 business fairly quickly. It's continuing to grow and scale. I know we really appreciate the partnership you've given. I know you work closely with TJ out of our Colorado office, so thanks for your trust in him. But you've just had an incredible ride. I just want to first start off by telling you and your team, congrats, kudos to the growth you've had. And it's been really, really neat to see what you keep doing.
Well, thank you. I appreciate that. It has been a journey. And to your point, starting out at the house and moving into commercial space, and it's been wonderful.
Yeah, well, you should be super proud. And everybody has their own journey. And I think the business you're in is a fun but challenging business. And my assumption is you'll agree with that comment.
Absolutely.
So, well, let's jump right into this question. And I was talking to you a little bit about before we hit the record button today, but you've got this debt to income problem you want to crack, and you want to figure out what is the right debt to income ratio. Why is this so important to you?
This type of business is so asset heavy. It literally is everything. And as we spoke about, before recording, it's a limited resource that you're trying to optimize for a somewhat unknown market size. We talked about the fact that it's similar to hotel rooms or airplane seats,
Yeah.
things like that. How do you optimize? How do you know when to, for example, buy a new plane? For our market, how do we know when to buy more of a particular item or get into a certain market that maybe we don't serve from a asset point of view or equipment point of view? And quite honestly, it's everything. I feel like the clients are out there for us, but how do we best serve them with the most amount of equipment that they need, but not so much that it's sitting unused on the shelf all the time?
Well, yeah, and it's that cross. And I think you shared this with me, right? It's that cross between is this an asset approach or is this an inventory approach, right? Like,
Right.
you're going to circle between the two constantly, and I definitely agree with that statement. I think most entrepreneurs that are listening or watching in, like they even if without the asset heavy business, I think a lot of people fully struggle to go, how much debt should I really take on to go after growth, to go after achieving my vision, or and every vision and goals are different, but how much debt can I really take and why? And so I thought it'd be fun today to slow down and first start with, what have you heard, right? There's not a lot of resources out there that talk about this outside of maybe the traditional bank answer, which I'll rattle off in 10 seconds here in a minute. But what is, then there's the operational side, obviously, of actually running the
Mhm.
business. But what have you heard? What have you found out so far on your mission to try to uncrack this big question of how to approach debt to income ratio?
Yeah, one of the most common things that I hear is get out of debt as fast as you can, sort of the same idea that a personal finance person might give. Um,
Yep.
but at the same time, I look at examples in the industry of debt to income ratios for those that are published, sort of publicly available information. And I noticed, wow, okay, these guys actually carry more debt than what you might imagine, and they seem
Hmm.
successful. They look successful. So that was a disconnect from these books that are talking about, you need to pay off that debt first and then operate on cash only.
Yeah, and there's a lot of schools of thought on how to run a business, and I don't think today is about saying one way or the other isn't wrong or right. It's actually about finding what's the best path for you, and I think everybody goes at it a little differently. I would love to back up and let's get clear on what is debt to income ratio and why is it important. And I'm gonna use it through the financial lens if that's okay. And Jared, you may or may not have heard this, but the SBA. I'm going to use the SBA as the authority here because they back about 70 to 80% of small business loans. So it's
Mhm.
a good institutional kind of lens to look through to say how do they view the business? What do they feel is an appropriate amount of debt? And they're essentially going to lay out and say it's very straightforward. You should always be below 50% debt to income. You should always be below that. And more ideally, you should probably fall around that 36%. And then they'll use the caveat to say, and the least of possible is always better. If you're below, though, if you're not below that 50%, you will not get a loan. You will not be able to get a loan. The other piece that I want to make sure all the listeners are really clear on, and Jared, I'm assuming you've got this under your handle already. Debt to income doesn't take how much debt you have divided by the amount of income you have. They actually look at it on a monthly basis. So the true ratio definition is to say, how much does it cost to service your debt per month divided by how much actual debt the amount you service per month versus the amount of income you have coming each month. And that's the percentage they look at. And the reason why it's 50% is because of taxes. That's the
Gotcha.
number one reason they're looking at that, right? Your principal isn't written off as a taxable event. The interest you pay on that debt will be written off for taxes. So they
Hmm.
know, right? They're running the math going, if you're in the highest tax bracket, which is what we're going to assume you are as a business owner, we know you're going to have anywhere from 36 to 47%, depending on your state tax, taken out of that. So we're just going to round down and we just know you got to be below 50%. And so what most banks are going to do is loan you based on what you can afford up to. Now that's to get the authority to take out the loan. That doesn't actually mean that's necessarily the rule of thumb as an operator when you run the business. But Jared, have you heard any of those figures before? Had you had that broken down that way before?
I have heard it put that way. When we were first starting the business, of course, we were heavily involved with the SBA to try and figure out what we could do in terms of loans and how to finance it. Because
Yeah,
as you can imagine, being so asset heavy, it required a pretty large initial investment.
quite a bit to get off the
I
ground.
mean, pretty,
Yeah.
yeah, yeah. I mean, we're not talking uh, millions of dollars, but it took a lot of money to get it off the ground because this stuff isn't cheap. But I have heard that number. I've also heard from banks where they talk about a four times your annual revenue would be the total amount of debt that you could have. So I'm not sure how those two numbers interact, but I imagine they're pretty similar for the same reasons.
Generally, yeah. I mean, every margin's different in a business, right? So, the percentage is going to be a little bit more universal. I think the banks are probably sharing that more for specifics of your industry. And generally, where your margin sits is generally the multiple that they can just quickly do the math on to go, how much revenue? Okay, great. This is probably where you're going to be at, assuming you're hitting
Mm.
this margin and hitting these covenants when we set up the loan. So it can be different by industry when you're looking at debt to income. But I think the first thing is understanding the why it's even structured. It's actually about being able to service the debt is the most crucial part. And then that ties in my opinion, so many more factors of risk. And so it was interesting when we were chatting, you were talking about the hotel space or the airline space. I'm actually going to go to the real estate space. I actually think there's a really cool model to take a look at. And I want you to think about the folks that are buying up real estate to Airbnb it. This is obviously a big, huge trend that's happening, especially across the states. And you're seeing more and more real estate investors go after the short-term rental, very short-term rental space. So similar to hoteling, but slightly different. And what you're seeing is how much debt they hold. They get the opposite advice from the books that you've shared, right? Get out of debt as quick as you can. Everything they're talking about is hold on to debt as much as you can. Maximize the debt for the smallest amount of penalty as possible, right?
Hmm.
Now, I think there's some lines that you can draw for the business, but it still comes down to ultimately your risk tolerance. Because the reason why I share that is why can you get so much more debt in real estate? Well, you actually have an asset to lean against. For you, you're going to have more people view yours as assets. Sure, there's an amortization. Sure, it does depreciate. Of course, it's going to fall down, in value over so many years. But it's probably at this point fairly calculated in terms of what speed the value is dropping on the technology. So it turns into this simple math of saying, well, how much do you have at what risk tolerance, but also to reach the potential of what these banks will give you? Because I'm assuming when you look at this debt, are you looking at the institutional banks or are you looking at personal debt, like having personal private investors invest in a debt round to help support you? Which one are you exploring right now?
Are you getting the advice you need for your business from this episode? Do you want to get more than just one question answered and have it customized to you and your business? Well, Cultivate Advisors works one-on-one with thousands of business owners every day. Let them help you scale your business today. Don't just listen to this episode. Take action and go to cultivateadvisors.com to see which advisor you get matched with and receive a free 2-hour business assessment on how you could scale your business to the next level. Act now at cultivateadvisors.com.
For the most part, it is traditional banking structures. When we first started, this was 2008, and they weren't interested in lending money at that point. So we needed to look more on the personal side. Yeah. But at this point, we have established enough of a baseline. Honestly, I got a little bit of a sour taste in my mouth because of the response that we got from people who weren't interested in the personal debt side of things. And now that the banks have plenty of history with us, they're more willing to take a look, and it just becomes a more straightforward process that way.
And you're always going to pay less on the institution side. So if you want to lend as much as you can up to what the bank will allow. And then if you want to have a higher risk tolerance, my experience is then you move into the personal debt side. And that's almost in every industry. Where you're going to pay higher interest rates. And it's really because your speed of growth is going to outmeasure the additional cost of the higher interest rates. Most personal debt, if you would ask me 6 to 9 months ago, I would have told you could get it for 8 to 9%. Right now, you're probably going to pay, 7, to 8, and before it would have been 10 to 11 even. Now it's, 7, 8, 9, maybe, because there's nowhere else for folks to put their private wealth. Right at this current time in terms of what's going on in the market. But what's really, really interesting about all this is that the banks are almost a guidepost of you actually are maxed out on debt. Because they're gonna calculate the math for you to say this is the amount of cash you actually have. So let's back up and talk about the first comment you made, which was, should I be trying to get out of debt as fast as I can, but that limits growth, or should I be taking on more debt to fuel the growth and make sure we have what we need for the clientele? My belief is that debt is healthy. That's my true belief. I've built and grown and scaled multiple organizations. This one I've done with debt. I had very little equity, mostly just team members that I allowed to buy in. I've scaled most of it with the capital needs for very quick growth. I did it with the desire to hold on to debt. Now, a thing that I measure more than I think that no one's really talking about is actually your debt to equity ratio. A lot of people don't talk about this, but I actually think it's a better lever for you to take a look at, because you said, am I asset? Am I inventory? In my opinion, you're an asset that has a shelf life. Like, that's how I would define your business. Because the reason why it's not inventory to me is because it does come back, right? It goes out, it's rented, it does come back. And so as you keep that asset, you just need to know, when does that asset go away, or at what speed does the rental rate diminish, right? And at what point is it all gravy? It's like, if you get past that, It's so conservative. You're like, okay, this is all just fun money coming in. I never would have expected to keep renting it.
Yeah.
Or I'm going to sell it at that exact value and then buy the newer equipment to be able to maintain. And you've got to come up with that strategy, get it very rigorous, very dialed in, and don't break your system, which I'm assuming you got a lot of that at moving and in play. Once you get that in place,
Absolutely.
that debt to equity, now that debt to equity becomes very important because it's sitting on your balance sheet, all the assets that you've taken on the loans. So that liability is on there, but I would be placing that asset on the balance sheet. I'm assuming you're doing that on your books.
We are, yes.
Awesome. So now that you get that on there, I have found that when you do that debt to equity structure, you now can actually come up with your rule based on your risk tolerance. Because ultimately, how I view it is the more equipment you bring in, the faster you're going to be able to grow. Now, I think the bigger question that maybe you're asking, but you haven't come out right and said, I'm really curious your perspective on this, is do you go after actually generating new types of equipment that you don't currently have? Or do you actually stay in the same lane to keep getting the same type of equipment to be able to niche in? How does that hit you when I bring
Absolutely. Oh,
that up? Absolutely, that's something you're faced
gotten
with?
to the heart. Yeah, you've gotten to the heart of the issue, 100%.
Yeah, I imagine, because otherwise it seems like your risk tolerance would tell you this is how far I'll take the debt. For me personally, I do follow more of the SBA structure. I am a little bit more traditional. I think a lot more about cash threshold than I think about debt ratio, but I'm in a service business, so I don't have to think as much about the debt ratio. But when I look at that debt to equity, if I've acquired a business, that's similar. I've acquired a business, I have something huge on the balance sheet that's an asset, but I have a big liability because I'm paying off that business. Well, I look at that and go, okay, I have this much more debt than I used to have, but my equity value has skyrocketed. And so again, if you start to run that analysis, you're going to find out what percentage where your risk tolerance lives and just make the call. Just go, that's our maximum. And this is the minimum amount of cash we can ever have. So when you run your future pro forma for cash flow, you go based on some stress test, what's the lowest cash I could ever go down to? I will never break these two rules. Now you grow. And the moment it opens up, you take it. The moment it opens up, you take it. And you let the business start to tell you, and you remove the emotion from your decision. But the biggest and hardest question, once you get that solved, what equipment do you buy and why? and that's going to be the hardest, in my opinion, for you to solve, because you've really got to make a branded decision. And my gut says there's two ways to figure this out. One, survey your clients. Survey your clients and find out what additional, you've probably already done this, what additional equipment do they need? What do you not have that they wish you did have? And I would get a wish list program going immediately. So you had an idea, and people could even start to vote it up. It'd be really cool if you had some type of tech system, a project management system that allowed you to do that, where people could vote up the different options so you could actually visually see the demand from your client base, because you've got a lot of clients you're working with.
Yeah.
To maintain this level of output.
Yeah.
I think that'll help. I think the second way that you look at this is you go, what is your cost of acquisition? And start to look at your cost of purchasing equipment to how that compares to your cost of acquisition. How many more people could you service, and how much would it cost to get those people into service if you just kept buying the same equipment and going, deeper, a mile deep, right? And an inch wide.
Mm-hmm.
My fear is if you go out and start buying a lot of specialty equipment, what's going to happen is you're most likely going to put yourself in a position where your debt to equity ratio is going to get a little wonky. Because what's going to happen is you're not going to get near as much money off of each of those assets, most likely, because I don't know if your client base will have the same demands long term. So again, these are things you've probably thought of, but what I would start to really process it if I was in charge of your business, Jared, is I would slow down to say, what would it look like if I actually went and found a competitor as my partner, where the additional items that that are kind of specialty items that we don't need to carry, I have the ability to get a discount because I'm renting so much, and you make, a quarter of the margin, let's say, but you have the ability to service your clientele. And you may already be doing some of that. You don't need to share for competitive analysis purpose on the call today, but I think it's important that you slow down and acknowledge where should you actually be releasing versus purchasing and leasing for the specialty. So that way, because I think if you can
Yeah, that
create a
makes sense.
tighter box, you should be able to calculate more clearly per asset the amount of cost, the amount of gains you gain from that, and apply that to your equity line. And that should tell you your ratio, and then you'll never break the rule. Where did I
Mhm.
get you? Like, where did I go? This is connecting. Where did I lose you? And where can we go deeper?
Well, I mean, you've had me the whole time as far as where you got me. I think that it's going to be important for us to define those numbers, to your point about what's the risk tolerance and things like that. So there's a little bit of a factor that will come in from a, multiply by 0.8, 0.5, what is that number to get your multiple for
Yeah.
risk tolerance? I also think that it depends a little bit on the type of gear that it is. Some gear, is workhorse, not really flashy, but it rents all the time. It lasts forever.
Yeah.
So you end up, charging a lower rate and it, you rent it for 20 years. Other stuff is kind of, 18 month, 24 month type of thing. And then it's out. So I think optimizing that per item or per class of item maybe is going to be important for us to investigate.
Well, what's really interesting about that is now you're doing more microeconomics towards your calculation, right? And what I like about that is now you're not treating just debt anymore. And that's why I think that debt to equity model is going to be a better structure for you than the traditional debt to income model. You'll know how the banks will view you on the debt to income structure. And it sounds like they've given you some estimates, even, for your business specifically. But I still think that going asset by asset to understand the timeline that I have and then connect how much risk are you willing to take on each of those assets, and then diversifying that within a niche is ultimately how you create the perfect storm. And then being daring again to leverage some other partners and vendors to lease out so you're still able to service it for your clients, because there's no reason why you can't market the ability that says, yes, we can get you this rare equipment because you have the hookup, and it's a loss leader. I think what you really have to start thinking about
Yeah.
is what are loss leaders in your business, right? This is a random
Yeah.
tangent. I used to own a painting company. The biggest loss leader I had was front doors. It took forever to paint front doors the right way. No blemishes. It has to be perfect. Somebody walks outside the house after you painted it, the first thing they look at is the front door. If it's not perfect, so we'd spend 10 times, you could never charge what we needed to charge to actually get the door done properly. Well, you need to start to think about what are those items in your business where you go, I'm not going to own this. This is going to be a loss. I'm just going to be the logistics coordinator to earn the client and then make my money on my products. Right.
Yeah. I think that
And
makes sense.
I think the more you start to think through those lenses, this debt to equity ratio is going to become very clear to you after you work through some analysis. And again, the most thing I have to validate for everyone listening and watching today is this debt to income ratio. Everyone seems to think it's like, I own this much debt, I have this much income. It's not. It's how much does it cost to service the debt? How much do I pay in principal and interest each month to make that happen? Jared, I want to bring up one other idea that I find a lot of business owners don't process. And I'm just curious, have you ever looked at a debt structure that is interest only?
Thanks for tuning in to Catapult Your Business, where Cultivate Advisors is helping you catapult your business one question at a time. Are you running your business, or is your business running you? At Cultivate Advisors, they'll match you with an expert advisor and do a free 2-hour deep dive for your business. This will give you the clarity you need on how to get your business to the next level. Cultivate has worked with thousands of businesses. What do you have to lose? So head over to cultivateadvisors.com and sign up for your free 2-hour session.
I don't think that anything has ever been offered to us that way. And so I haven't then sought it out. Can you tell me more about what that even means? So you carry debt forever?
Yeah, well, usually there's a cycle payoff period. But so the way that I built this company actually, and where I think a lot of people just don't even realize what's out there. you mentioned you went out to the personal side. It was kind of met with some hurdles, right, to kind of jump through to be able to get debt from personal folks. You've grown quite a bit since then. I think you'd be met with a little bit more openness because you have a track record to show and a sizable company now to lean against. However, what I found is that most of these private wealth individuals that will invest in smaller businesses like yourself, they actually don't want the capital back. The way that they make them the most money is keeping the whole thing in play. So they don't want the principal to necessarily come back. Instead, what they would do is they'd set up like a 3-year loan where it's all due in 3 years. And you'd say, well, why would I do that? Well, they're going to probably require a 10% interest rate. It's going to be, 4 or 5% above what you normally will get from a bank right now. And the downside of that is the additional interest. The plus side is you can keep the money in play. So you have a longer timeline to start to get it rented and start to get more and more uses out of it to get money back to start to pay for itself and let the money do the work. Now, usually a lot of these deals will have some type of convertible note. So in the event you can't return the money, they get to take some portion of your company. So you're leaning against your entity, which is better than a personal guarantee, right? If you're gonna lose out, you don't want that to be on your own individual self. You'd rather be it against the asset of the business.
Right.
And so the way that you structure this is again, like I said, 3 to 4 years, but the most common way you buy out of that is you actually then have the bank recapitalize you and take out your private investors. So you could go off and loan, much larger of a debt amount through personal raise, lean it against, a convertible note in the value of your business, set up the interest only structure, get to utilize the cash and rotate it multiple times before you then return the funds. And in the event you don't have enough to return the funds, which you probably won't if you continue to grow and you're investing in growth, you then can use the bank to buy out those investors because you've shown the interest payments, you've shown the revenue's massively increased, and now you'll qualify for those types of levels. Now, that's a little bit higher risk, but that's how a lot of people, most likely in your space and in most asset-heavy spaces, they're leveraging very creative structures like that to open the window when you run that cash flow pro forma to realize how much more debt you could take on, because again, it's the cost of servicing it, not actually how much debt you're holding. Because when you compare that to the cost of equity, right, the ratio, you still see that you're on top because you'll never flip because the amount of assets are always increasing on that balance sheet.
Right. And the whole idea is that you could then borrow more from these private investors than maybe a traditional bank would do. And so you get the benefit of that higher cash flow to work with without the risk of also having a higher monthly payment because you're keeping the principal behind.
Bingo. And a lot of times, like for instance, I'm a believer of like, I take out more debt than I need always. Like I sit on cash. There's enough money market accounts and other things you can get a couple percents on. You'll never get it back fully of what the interest costs are, especially in today's environment where the interest rates have ballooned a bit lately. But they're still relatively, in the course of 100 years, low. It was a really great period the last 5 years before. And you're going to see more and more people taking less and less debt because of it. But I think what's important and we have to just always be mindful of is interest is like paying an insurance policy. We pay a lot of insurance money to protect our asset, our business, our baby. We have all the right liability and protective insurances, I'm sure, around all your assets that you own when you're sending them out.
Of course. And
so as that happens, it's no different. You're paying an insurance to maintain an amount of cash, right? Because my curiosity is how much of this is pre-planned in your business versus how much do you actually slow down to go, I'm going to wait for the customer, but be able to make the purchase quickly, right? Like how much do you navigate
that ratio,
that way?
Yeah, that's a tough one to do. And I think that
ratio
a lot of times the ratio between what our clients are asking for versus what we see coming up in the market. And honestly, it depends on the client themselves. Some of our more informed clients or those that are doing industry work on a consistent basis are coming to us saying, hey, when are you going to carry this? But at the same time, One of our strengths is that we are viewed as a gear expert or equipment expert in this industry. And so people come to us and
Yeah.
say, hey, what is this new thing? Are you guys going to carry it?
Yeah.
And we become sort of curators of what we think is important in the market and be able to offer that to clients. So sometimes it goes both ways, and figuring out that ratio between what we're being asked for versus what we see and can take a guess on that will be popular.
Yeah, no, it makes a lot of sense. And the coolest part, again, is that your branding shifts to we'll help you find the equipment, but hold based on
Right.
what the ratio tells you to hold, have your confidence in your rules, don't break them, and come up with other options to
Yeah.
service your clients. And I'm telling you, you don't break that box. This thing should be able to keep growing and growing and growing. You just have to make those core decisions. So you told me before we got in, like you can't find a lot of resources on this debt to income ratio. Did you at least capture one or two things that have you slightly tweaking your brain on how you look to DTI? Or honestly, what I want you to look at is debt to equity.
Absolutely. I didn't want to be furiously scribbling notes during this, but definitely want to review what we talked about and go through that and specifically get some numbers in front of me and work with that. I think it'll be a lot of, I'm kind of a numbers guy, so I think it's going to be a lot of fun to do that and sort of set those definitions.
Well, Jared, if you're not on it yet, get on Live Plan. You get access to Live Plan when you work with TJ, and that is a cash flow performance software that'll actually project out that cash flow and let us run a bunch of scenarios. And I know I speak for TJ when I share. I know he really enjoys working with you and what you guys are working on. But additionally, TJ, I know is standing by, ready to dig in deeper with you on this to make sure we get you over this line. So thanks for being bold to bring the question and allow. I know there's a lot of people. Financials is kind of like that thing you put in a cave and you try to forget about. A lot of people do that when they run a business. And I think, bringing this to the forefront and really talking openly, like how much debt is the right amount of debt? And how the heck do I know that? And you've got some percentages to go back and look, but ultimately your risk tolerance is going to tell you on that cash flow of being able to service it. And my gut says you're going to land most likely in the 40s as a percentage. That's what my gut on a serviceable level. That's where my gut says you're going to find, because anything over post taxes, when you see the cash, truly your cash, not P&L, truly your cash movement, you're most likely going to start to get very uncomfortable unless you go use a unique structure like I described, where you do an interest only approach with a convertible note that pays off over time. That's how a lot of big players have gotten big really quick, outside of bringing on an equity capital partner, which is also another option. But Cultivate's mission is keep your equity. There's other ways to approach this. The equity is what you're worth when you go to sell or do whatever you do with the business in the future. So, well, I want to make sure people are able to find you, Jared. So if people have a need to rent this really amazing equipment that you bring to the market and have your consultative approach and the guru of gear per se, where should they go to meet Jared and the team?
Sure. Yeah. We do serve clients nationwide. We're at prophotorental.com, and photos PH. There's a brand that spells it with an F, but ours is prophotorental.com.
And we'll put it in the chat or in the comments underneath the podcast here. So we'll definitely make sure people find you. Again, Jared, thanks so much for slowing down and sharing the insight and allowing us to help catapult your business one question at a time. And for all of our listeners today, both video or via podcast, keep on the entrepreneurial journey and catapult your business to the next level. And we'll see you next time. Thanks again, Jared.
Thank you so much for having me.